from London. Welcome to the RANsquawk Weekly Wrap. Just going to answer some of the questions we've had through to the desk regarding the developments we've had this week. So all the focus this week has been on the Eurozone debt crisis and the Eurogroup leaders' effort to try and stem the Eurozone debt crisis. We've seen a marked increase in risk sentiment across the board, particularly in the equity space and the Eurozone currency. But taking a look at the closer details, they're actually quite sketchy and hard to draw any conclusions from, particularly in terms of the EFSF and its potential leveraging. Taking a look at the implications for the sovereign ratings, it has increased countries' debt or risk profiles, particularly France being a case in point. The pressure being put now on the French sovereign rating in terms to its liabilities for the EFSF will take some scrutiny by the rating agencies once the concrete details have been defined, which will be expected at the G20 summit meeting. Any potential downgrade of France will reduce its capacity to lend to the EFSF and which will have potential catastrophic ramifications. Elsewhere, looking at the potential guarantees from China, that has been, well, there's been some cold water thrown in that respect from the Chinese officials today. The Chinese Vice Finance Minister noting that at the G20 summit they will not discuss EFSF investment, and the head of the Chinese Banking Regulatory Authority today saying that the EFSF proposals must come under some tighter scrutiny before China can consider investing. That's quite contrary to the reports we've seen in the FT this morning saying that China may actually increase their investment up to $100 billion. So the head of the EFSF, who is in Beijing, does have his work cut out in that respect. And finally, looking at the developments in Germany today, the German Constitutional Court ruling that the special committee set up in the German Bundestag or lower house is actually to be suspended for now due to complaints from two German lawmakers who have said that is unconstitutional. So now the whole Bundestag has to vote on any EFSF amendments or changes, which could delay the process, and a senior German lawmaker already saying that this may stop EFSF bond buys in the secondary market. So there's increased uncertainty here, and the EFSF is by far from certain to become operational, and the debt-solving device which the Eurozone leaders has hoped so far. So we keep a close eye out on any further developments regarding the EFSF, because right now it's pretty much up in the air. So taking a closer look at Italy then, the third most indebted nation, the positivity following the Eurozone summit was supposed to have dissolved some of the cynicism surrounding Italy, but looking at the BTP auction results, this has not been the case today. The 10-year benchmark BTP selling at a yield of 6.06%, the highest since the introduction of the euro currency. A disappointing auction from Italy all round, and we've seen the market increase in risk aversion immediately following these auction results. A lot of focus on the Italian PM Berlusconi, who has pledged before November the 15th to outline the concrete budget measures for the country, but given his current track record, it will be not unexpected for Berlusconi to throw a spanner in the works here. He's already fallen out with the Italian Finance Minister Tremonti, the man tasked with turning round the Italian economy, so it does not bode well with the political infighting in the country, and now the record high yields with the 10-year Italian cash yield currently trading back up around the psychological 6% level. And with the EFSF and the leveraging of the EFSF somewhat up in the air as previously noted, where does this leave Italy then? If Italy is the next country to fall, will the EFSF and the debt measures taken be enough to save the country? On paper it does not look so, with Italy that already noted being the third most indebted nation. So lots of uncertainty here also regarding Italy and where we go forward from here. Lots of focus on the budget reforms they are due to take, and on that note we come to next week and the ECB's rate decision, where now many analysts are expecting an ECB rate cut. And another thing to throw into the mix is that ECB Draghi will be the first, or the former head of the Italian central bank will now be in ECB's Trichet's seat. So it'll be interesting to see his press conference and how he deals with the current turmoil that is in the Eurozone, despite the veneer given following the Eurozone debt crisis. So it'll be an interesting week going forward. It'll be nice to have a discussion regarding this with the video with you guys next week. Otherwise, enjoy a great weekend and your trading day next week.